We pour our lives into building our businesses, but a lot of times when we start looking towards the exit, we begin to realize that we did a really great job at building income, but we did a pretty crappy job at building wealth. The guest that I've invited onto the show today, he's helped entrepreneurs be able to flip that script in some pretty awesome ways, turning exits into the prosperity that we all want. You see, Alan Franks is a fee-based certified financial planner. He's an author, he's a speaker, and he takes a different approach than most advisors. Instead of pushing products, he actually helps entrepreneurs and families define the lifestyle that they want and then reverse engineers a financial plan that actually gets them there. Most financial planners provide cookie-cutter strategies that may make sense for the high-income corporate worker or may make sense to keep assets under management on their platform so that they can make more commission. But the needs and wants of entrepreneurs and business owners are different. They're nuanced. You know it, I know it. And finally, a financial planner named Alan Franks who knows it. So I invited Alan on the show to talk about what business owners should be doing now to make sure that their business becomes the wealth building machine that they intended it to be. This is On the Exit. All right, so Alan, over the last kind of 15 years, as far as, as we've kind of got connected with you and, read a lot about your bio and stuff like that, it seems like you've worked with a lot of business owners as well as a lot of other folks to kind of build strategies for them in the area of financial planning that are, cost effective, but really tax advantage strategies so they can share, keep more of their hard-earned money, share less of it with the government. That's always a win for us as business owners. And you also wrote a book, right? You're the author of the book Empowered Money.
That's right.
And the creator of the exit planning framework, which is a very practical way for entrepreneurs to build enterprise value and prepare for life after business. So I say all those things to say you've done a lot of cool stuff, written books, created businesses, helped a ton of folks be able to turn their income into wealth, their business into long-term generational prosperity. But what in the world made you want to get into that world in the first place? I want to hear the story, man.
Absolute necessity is what happened, Caleb. I had no choice, man. So, a little bit about my backstory is I come from a family of entrepreneurs. My dad owned about 5 different chiropractic offices at one point, a bunch of real estate as well. My mom owned her own aerobic studio. Their parents were entrepreneurs. Nice. When I was graduating with an economics degree in 2010 and just the depths of the economic recession, there were no jobs. I thought I was going to be jet setting for some hotshot consulting company. Yeah. Man, I didn't even sniff an interview, right? So when I graduated, I had 2 opportunities. One was to go teach elementary school in the Mississippi Delta for Teach for America, which would have then led to business school. And then the other one was to take a commission-only sales job at a local financial institution.
Okay.
My parents didn't want me to go to the Mississippi Delta. And honestly, I felt like I was kind of born to do what I'm doing, right? My dad, we used to play Cash Flow, the board game by Robert Kiyosaki as a family, right? My dad had signed up for this crash course from Kiyosaki that he allowed me to listen into. I remember going in, my dad would bring me into meetings with his investment advisor, with his insurance broker, he brought me to the closing when he bought 6 homes one time in Athens, Georgia with no cash down, right? So I got to see how somebody can build generational wealth in one generation. Yeah. And that was so cool. And I'm so lucky to have gotten that education, right? Mm-hmm. And more importantly, I was learning from my dad's successes. Because I'm his financial advisor as well, I've been able to learn from his failures as too, which I would actually say I've learned more. So us as parents, when we're trying to build multi-generational wealth, remember that legacy is so much more than money. Yeah. Legacy is the story and the lessons that we have learned, passing those down from both our successes and maybe more importantly, our failures, right? Yeah. And of course, if you've got a 5-year-old kid and they think you're a hero, maybe we don't tell them about the failures just yet, right? But as they get older, we need to make certain that our kids don't repeat the same mistakes that we've learned. So I think in today's monetary society, we've forgotten that legacy is not just about how much life insurance we have or how much money or how much real estate we're going to leave them. It really is, okay, if we're going to leave you with money, how do we also leave you with the skill set to multiply that money?
Yes. No, I love that, Alan. It resonates so deeply with a lot of the stuff we talk about on this show because, I'm a father of 3. Aaron, my co-host and business partner, is a father of 5. He's got 5 boys. I don't know how he does it, but we've had several episodes even of On the Exit where we've talked about how we are, trying to impart financial skill and ethic into our children. And my kids are 7, 6, and 5, right? As early as that, it's so important because, I interviewed a guy, I don't know, a year and a half ago by the name of Keaton Hoskins, who talked about how he wanted to die with $0 in the bank because he'd never seen a kid who inherited a bunch of wealth make good decisions. And I'm like, I don't think that's true. I think that you can leave a legacy and an inheritance. And if you leave the right kind of legacy, then you can leave a sizable inheritance. And, your kids are just starting further ahead than you did. So obviously we want to get into the business side of it, the financial planning side of it, but what are you doing to kind of prepare that for yourself? Obviously, it seems like your dad did that very well for you, right?
Yep.
Giving you that example, sitting at the table, playing Cash Flow by Robert Kiyosaki, all the stuff. How are you taking that legacy? Because, legacy, like by definition, is multi-generational, right? So how are you then duplicating that now?
That's right. So first of all, nothing against your old guest Keith, but I would not work with him as a client. I would not. We share a different value set, right? And for most of my clients, what I'm trying to help them do is reach something that I call critical mass. That moment of critical mass in their wealth is when their money is making more money than they're spending, right? And so when we looked at a financial plan, I just want to let you know, if money is going down, it's going to be stressful. I don't care if it's $10 million that's going down. It's not fun to see your bank accounts go down. Even in retirement, I want to see your bank accounts go up, right? Why? Because making money is fun, right? And that's what I'm trying to give my passion, my clients, to say, hey, listen, I know that new car looks so fun. I know that this looks really fun. Let me tell you what's also fun. Creating multi-generational wealth. It's a lot of fun. And I'll tell you, unfortunately, from a sad instance here, we had a client recently who lost their only child. And this client's very well off. And now all of a sudden, it's a mind shift of like, well, what in the hell do we do with our money now? Right?
Yeah.
We had a plan. They have more money than they could probably ever spend, right? And they were planning on passing this on to their son. And all of a sudden they don't have that. And so what happens here, guys, is that we did increase spending, but guys, it's kind of shallow, right? It's just to cover up the pain of that, right? And so having this mission of leaving something that's bigger than yourself and leaving the next generation, so where your ceiling is their floor, that is a really noble goal in my mind. So when I started off, I had almost zero help, right? I had zero income, zero clients to call on, zero knowledge of what the hell I was doing. And Caleb, I ate a sandwich for breakfast, lunch, and dinner every single day for 5 years. It was, I hope I can say that on here. It was, I wouldn't wish it upon my worst enemy. And even though there was a lot of character building that went on there, I'll be honest with you, there's better ways to build character than what I went through. And I don't want my kids to have to go through that. I want them to inherit or at least start with a really good business model where they can take it 2-3x from what I did and not have to spend 5 years just trying to figure out what the heck's going on, right? And so my thing is I want to make certain that my kids 4 is my ceiling there, and that's what we're building.
No, I love that. My very first business mentor when I was 18 years old, a guy by the name of Michael Crowder. I've had him on the show. He's actually my first cousin by marriage. So that was how the relationship was there, but he was the most successful person I knew, right? And so I'm like, hey, man, will you help me figure this thing out? And he happily did, and he's awesome. He's a fantastic businessman, has been for a long time. But he gave me the definition of prosperity, and I'll never forget it. It was prosperity is having enough money coming in passively, residually, whatever it is, that you don't have to go out and earn and trade time for, having enough money coming in that you can cover everything you need in your life and have a little bit left over.
That's right.
That's prosperity. That's right. And so if you can define it in that way, that seems like your definition of critical mass, right? It's like you want to have enough, your money's making enough money for you where you can cover all the lifestyle that you've designed and want to live. And for some people, that lifestyle's super ambitious. They're not going to be happy if they don't have a new Lambo every 3 years. They're not going to be happy if that. And I'm not like that. I don't care about all that stuff. I'm not a flashy guy. But I know some people do. But what that means is you're just going to probably have to work harder for longer to get enough that your money working for you will cover that lifestyle, right? Would you agree with that?
100%. So it reminds me of this passage in this book called The Psychology of Money, which is one of the best books I've ever read on personal finances. And it talks about this author talking to a private equity person. And it's a really good story. And the author is actually famous. So I don't want to mention his name and get it wrong. But this private equity person was basically telling him everything that he has, boats, homes, everything, right? And he asked this famous author, and he goes, what do you have, right? And he says, I have something that you'll never have. I have enough, right? I have enough.
Wow.
And man, if I were to put, out of the thousands of people we've worked with, if I were to tell you, okay, who are the most financially successful people? It's the people that find joy in the simple things of life.
Yeah.
Right?
Yeah.
That don't have to always be distracted by something, that don't have to always be buying something, doing something, right, going somewhere, right, that can simply be at home and have fun with their family, right?
Yeah.
That is who tends to have more financial success. And I've met with attorneys who make really good money and they spend all of it. Right?
Yep.
I met with a surgeon the other day who makes $600,000, which is just enough for his 3 kids to go to private school, his wife to stay home, and them have a really nice home. Right? And there's not much left over after that, right? So the practice of enough, right, is one of the biggest indicators on if you will have financial success. Because I remember this meeting so well. There was a guy that I met with. Unfortunately, he didn't become a client. I wish he had. But he had never made over $100,000 in his life yet. He had $4 million saved up.
Wow.
Right?
Yeah.
So you talk about, okay, it's not necessarily what you make, it's what you keep, right? And what does that mean? All right, well, we need to not only practice really good cash flow management, but we do need to lower your biggest expense, which guess what? Is not your home, it's not your food, it's not your car. It's your tax bill to Uncle Sam.
Yeah. Yeah. Taxes. There's two things certain in life, right? What do they say? Death and taxes. So then let's talk about that, man, because I know a lot of our listeners, they have higher incomes, right? And in my primary kind of business, we're a private real estate and alternative investment firm. We do investments in multifamily real estate, both acquisition and development. We do some investments in oil and gas specifically. We're really excited about oil and gas, not just from a return standpoint, but from a tax standpoint. I mean, some of the best tax advantaged stuff that people can invest in. But I mean, a lot of these things, right? A lot of our listeners, a lot of folks, they're familiar enough with things like bonus depreciation on real estate or, intangible drilling costs in oil and gas, where they can sometimes wipe out 80-90% of their invested capital in year one. They're familiar with that, but speak to some other ways that you help your kind of higher income, higher net worth clients manage the tax situation and pay the government less. If there's anything I want more than anything in this world is to give the government less of my money. Okay.
That's it, man.
So
it's a fun game. I would tell you this, I believe that we've actually become more of a tax mitigation firm than anything, right? So we're dealing with high net worth people. There's 2 things that they really care about. Number one is tax savings, and 1B is estate planning, right? After we talk about those, then we talk about their investments, their insurances, their financial planning, everything of that nature, right? But the reason why people work for us is I go to bed dreaming about tax savings. That's it, right? I'm not a CPA. I don't prepare taxes, right?
Yeah.
But we're constantly thinking about, okay, how do we lower everybody's biggest expense, which is taxes? So when we're thinking about taxes, it's important to break it into 3 different taxes. Number 1 is income tax, where we spend the bulk of our time. Number 2, though, is we cannot forget about capital gains taxes, right? They are legitimate, right? Particularly if you're in a high income tax bracket, if you have state taxes, you're going to be paying roughly about 30% on capital gains taxes. That's really going to put that's going to grind on the gears of your wealth accumulation over time, right? So helping eliminate capital gains taxes. And then I would say this, if we do planning right, I hope that you have the risk of paying an estate tax later on. That's a really good goal, right? A really good goal. Now, why is it? Well, right now under current tax code, you have to have like 15 million per spouse in order to touch the estate taxes, right? But if we look and we compound your money over time and we do this well, we will probably be close to that. So we need to keep an idea out there of, hey, how do we make certain that we're lowering our long-term estate taxes as well, right? Now, most of our clients, though, are in high income tax brackets, meaning that they are paying 42, depending on the state taxes, anywhere from 40 to 45 to Uncle Sam. Right. So in my case, Uncle Sam and Aunt Georgia, because I'm based out of Atlanta. Right. So what are we doing there? There's 2 playbooks. One is a playbook for W-2. Okay. And that playbook's about 2 pages long. Right. The other is the playbook for the business owner. And that one is growing and growing and growing. And it's almost never ending of what we could do right there. Right. So yes, we're going to talk about oil and gas tax credits. Yes, we're going to talk about, particularly for W-2, we're going to talk about cost seg bonus depreciation right there, which at the end of the day, guys, the tax savings are basically paying the down payment on the rental home or on the storage facility, right? Which is totally fine. I just wanted to, you're not going to save money that year. It's actually probably going to spend a little bit more than you save, but you're going to have an asset that's going to grow for you over time too, right? So a way to build wealth, but maybe not a way to save on taxes, right? And then a new one right now that we're really focusing on is like heavy machinery, actually. There's really good loan provisions on that. So what I like about cost seg bonus depreciation and heavy machinery is that we have the ability for leverage. Okay, right? So we could put 10%, 20% down to get $1 million asset, right? You know, and depreciate the entire $1 million. That's one thing that the oil and gas lacks a little bit, is the ability to leverage on there. But when we're looking at a tax strategy, we want to combine all of those things. Now, that's W-2. If we go into business owner world, man, whole different ball game here. I'll tell you what we're doing right now, a lot of where it fits is this idea of a defined benefit pension plan, where we can actually say, hey, we want to pay ourselves X amount in the future. Now we can reverse engineer a number using actuarial science to get your 401k that you typically can only put like 24 grand in. Next thing you know, we're putting 240 grand into some sort of plan to deduct, right? So depending on the person's needs, we can really design a good income tax plan for them.
That's great. No, that's great. So when I talk to guys who are, or gals who are really informed in tax world, and obviously I'm informed to the degree that I want to know enough to not have to pay tax as much as I can, right? But I'm more focused on the investment and wealth growth side, right? Like that's more of my area of expertise and strength. But it's tax advantage is absolutely critical. So I always ask this question just because of curiosity, right? Curiosity killed the cat, but I got 9 lives, so I can ask 9 questions, right? So what's the most creative, and whether it's a story, situation, whatever, what's the most creative tax solution that you've ever implemented on behalf of a client?
Yeah, that is a great question, and one that we're actually, I would say, currently implementing right now. And I'm trying to think of, okay, so this guy's a business owner, okay? And so we had the ability, and he wasn't doing anything in a 401k or anything of that nature. So we had the ability to go in and implement, and he's making a good amount of money, making a really good amount of money, right? Yeah. We were able to go in and implement a 401k, get him to 23,500, right? And then get him a defined benefit pension plan that he's going to allow him to do about 250 grand. We're then going to add his wife to the payroll, and we should be able to deduct another 250 grand. We might even add a father to the payroll. Okay.
Okay.
Now, how cool would that be? Now,
Yeah.
all of a sudden, we're going to be tax deducting life insurance, some life insurance dollars that will end up coming back to us tax free.
Yeah.
So it's a really, you got a father of 65, right? We got another 20, 20 years at best, right? Tax deduct premium in order to get some life insurance that will come back to you tax free. But we're not going to have it go to him. We're actually going to have it go to his kids. So it's skipping a generation so that he doesn't have to pay estate taxes.
Right.
Now, on those lines, what we're also doing, we're going to get deep here, Caleb. We're also recommending that we sell the business to a Beat It trust.
Okay.
That's a beneficiary trust right there to get it outside of the estate.
Yep.
Right there. And now all of a sudden, as he grows and he sells that business, a lot of that wealth is going to be outside of his estate for estate tax purposes. So now we're really lowering the overall estate taxes on there. And so that is one area right now where we are working on that. Man, there's just a lot of arrows that we were able to get.
Yeah.
Now we're able to do some other things like get the kids on the payroll here. If they own a commercial building, we're able to go in and do the cost segregation, bonus depreciation on that commercial building right there. And so, we threw the entire tax book at this guy, right? Mm-hmm. And one of the things that's challenging is, if we were to come to anybody and throw everything at them all at once, man, it's really overwhelming. Yeah. So it's like, okay, what do we need to get done this year? Okay, and what do we need to get done next? And so realistically, the reason people hire us is that we are the master of GSD. We get done, right? Because, I would say this, when we come into a business owner, a third of the stuff that we are doing, they already know that they should do.
Yeah.
Right. We're just holding them accountable and holding their hand as they do it. Another third of the stuff is stuff that they probably never knew about. And that's where it gets really fun. We're able to add a lot of value there, right?
Yeah.
And then the third of the stuff, and I'm fully transparent, is stuff that we're going to figure out together. Yeah. Because this world right now, Caleb, is changing so quickly, right? For instance, we are battling right now with I-9 issues with undocumented workers, right? Yeah. Listen, if you own a construction company, if you own a roofing company, guess what? Absolutely. There's some undocumented workers that work for it. You may not know it, right? But they're there, right? Next thing you know, you go to sell your company and they want an I-9 form for all of your employees. And like, oh my gosh, this guy's been with me forever. All of a sudden, you're having to fire one of your best employees so you can make the sale. It's a problem. And guess what? There's not a good solution here, right?
Yeah.
There's not. And so we're having to work through this with our clients. And this is something that, yes, it's been there for a while, but it's just more magnified at this moment in time.
Yeah.
Tariffs are another example. This is a whole new world that we're going to go in. And guess what? We're about to find out, y'all, that tariffs are a lot more complex than we originally thought, right? Yeah. And so we're about to, it's going to take a couple of years, but there's going to be some side effects of these that aren't going to really present themselves over time, right? So we're helping our business owners plan and prepare around those. So a third of the stuff is stuff we're figuring out with our business owners.
Absolutely. No, that's I'm going to be honest with you, Alan. I don't like most financial advisors and people that do this. I don't like it. But I like you. And the reason that I like you, I read your stuff and having these conversations with you and getting to know you is, most financial advisors, and I'd love to hear if you agree with this statement. And if you disagree, you're welcome to be wrong on my show. But most financial advisors are incentivized to keep assets under management on their platform in the cookie cutter boxes and solutions that they have. And the average financial advisor in America makes $103,000 a year, has no real wealth of their own to manage, and is not incentivized to know this information. They're incentivized to get commissions. That is what that's been my perspective of most financial advisors. But when you've got someone like you that looks at the whole picture, that cares about the holistic picture, that's not discouraging someone from doing X because if they do Y, it means you make more money. It means you keep more assets on your platform or whatever that is. So, but I guess there's, as you know, and on my end of it, there's a growing wave of a higher net worth, people, accredited investors, people with 5, 10, 15 million net worths. There's a growing wave of those people who are not ultra high net worth, but high net worth that are moving more and more toward alternative investments, private hard assets, right? And I work with those people all the time. They're investing in deals that we're operating and sponsoring. And the biggest fights they have are with their financial advisors, because their financial advisors don't want them to take the AUM off of their platform and off of their, out of their Schwab brokerage account and all that kind of stuff. How do you deal with an investor or a client that comes to you and says, hey, Alan, I'm looking at this, syndicated real estate opportunity. It's with a great operator. It's this, it's that. I'd like to throw $500,000 at this. I think it's a good deal. How do you deal with that investor? And what do you tell them and that kind of thing? I want to hear it. I want to make sure I like you.
Yeah. Yeah. So Caleb, first of all, what you said about other financial advisors was 100% spot on. 100% spot on. As a matter of fact, I would say my biggest marketing tool is other financial advisors, right?
I love it. I love it.
Right.
Yeah.
So when we sit down with people, I say, hey, I just want to let you know, if you were to go interview 10 financial advisors, 5 of them are going to be investment focused and they're going to get paid off AUM, right? Mm-hmm. And that's totally fine. But that would be kind of like getting into a car with only a gas pedal, right? Yep. They're only focusing on the offense there and they really only focus in on investments, right?
Yeah.
Another, 4 financial advisors out there would be out there and they're in the risk management camp. Disability, long-term care insurance, life insurance, car and home insurance, right? And that's kind of like getting into a car with only a brake pedal, right?
Yeah.
And then 1 out of 10, maybe 2 out of 10 would be like getting into a car with both a gas and a brake pedal in a way where they complement in so we can drive your financial engines like Formula One race car, right? Mm-hmm. And while we're building this car, let's throw in some added accessories like a cash flow tracking system. Let's help you choose your employee benefits. Let's do your estate planning for you. Let's price out your car and your home insurance every single year and audit it, right? Let's go in there and let's talk about the idea, of course, of investments and tax advantage investing, but the idea of debt and leverage and show you what wealthy people understand about debt that most people don't, right?
Yeah.
Because what I've got to get over are the Dave Ramseys of the world that are against debt, right?
Yeah.
Now, to be clear, Dave Ramsey, not a financial advisor, but one of the best marketers that I've ever seen, okay? Yeah. And to be clear, for maybe 80, maybe even 85, 90% of this nation, that's the message that they need to hear. I just work with the 10% that don't need to get out of debt. They're looking at accumulating wealth, right?
They need to get more into debt, so they're paying less taxes. They need to buy heavy machinery, leveraged, right off the million.
Are you my brother from another mother, man? Like, you were speaking my language today, right? There's good debt and there's bad debt. We talk about this in my book, and it's understanding what bad debt is, eliminating it, and getting to the root of the problem of how do we get into bad credit card debt. And then there's the idea of good debt, right? Of good debt. And that's such a foreign concept because guess what? Our parents never told us about good debt. They only told us about bad debt, right? Why? Because our parents grew up in a time where credit cards were becoming the norm and they had so many friends that had bad habits to get credit cards. And guess what? Guess what debt is? Debt's an accelerator. It can accelerate a really bad habit and get you in a lot of trouble, or it can accelerate really good habits and help you build wealth, right? So let's talk about leveraging, okay? 100%. And I was just going to go back to one thing. Everybody always looks up the 5 questions to ask a financial advisor. Okay, I want to give you one. All right, everybody before they meet me, are you a fiduciary? Yes, I am. What do you charge? All this stuff. No, none of that matters, guys. Here's one question: can I see your financial plan, Mr. Financial Advisor? Right? Because what that's going to do, if he shows you, he's about to ask you all these, he or she's going to ask you all these nosy questions, right? And you're going to know everything. He's going to know everything about you. He might even know you better than you know yourself, right? Yeah. He might know you better than your spouse knows you by the end of this meeting, right? A good financial advisor, I consider myself, I know more about my clients sometimes than they do. I know their fears. I know their habits, right? Yeah. So I think it's fair game for you to ask the questions the other way around and say, hey, can I see your financial plan? And here's where I get excited because I love my financial plan, right? Because everything that I tell my clients to do, I do myself, right? I practice what I preach. And I'll tell you this, and this is not a knock on other financial advisors. Being a financial advisor is tough. It is, you're running a business. You got marketing. You've got clients that you got to deal with. You got compliance, illegal. There's a lot of red tape we have to deal with. And guess what? It's really hard, right? And frankly, it's kind of, we've got 2, 3 full-time staff, right? And so I'm not knocking other financial advisors,
Totally.
but sometimes they don't do their own financial advising. Sometimes they don't practice what they preach. Right. And so what I would encourage you, don't ask all the fiduciary questions. They're just going to tell you what you want to hear. And ask one question. Can I see your financial plan? Right. Yeah. And that my eyes light up when people ask me that, because I show them my financial plan. It's like, this is what I'm doing with this syndicate. Here's what we're doing with this real estate. This is what this business is doing. Right.
Yep.
But what I would tell you is this: when a client is trying to decide whether or not to put money into the market, or whether to put money into a real estate syndicate with you, with somebody else, you name it, right?
Yeah.
The biggest cost to this, okay, is not your fee. It's not the fee that the financial advisor's charging, right? The biggest cost is something called opportunity cost.
Yep.
And we need to understand that. If we do this over here, that means we cannot do this over here, right?
Yep.
But if we do this over here, we might be able to do this over here. So the idea here, how can we eliminate your opportunity cost? So rather than making this an either or conversation, what if we were to do a both and?
Yep.
Okay.
Yep.
Now, here's the deal. The truth is, in our algorithmic world, okay, when we get on Instagram and Instagram tells us what we want to hear, we have really specialized. And we have 3 types of people out there. Okay. We have your real estate bros, your crypto hoes, and your stock junkies. Right? Right? Real estate bros, crypto hoes, and stock junkies. And guess what?
I love it.
If you're a crypto hoe, you see everything through the crypto lens, right? If you're a real estate person, you see everything through the real estate lens. If you're a stock junkie, you see everything through the capital markets. And guess what? You're right. If you've done one of those 3 things, right, you've won. You've won, right? Here's my plea to you. Is we have no clue what the next 5 years are going to hold, but they're not going to be like the last 5, right? Why can't we do all 3? Right now, let me add a couple other people identities that are really starting to show up. Number 1 would be the business owner, right? So Cody Sanchez, Main Street Millionaire there. She's got everybody trying to buy a laundromat right now, right? Everybody wants to go buy a coin laundromat right now. And you read her book and you are just jazzed to go buy a business, and you don't realize how damn hard it actually is, right? You know, the second thing I would say, and I'm certain you've had these people on your podcast, are the life insurance people that claim life insurance is a magic solution for everything. We're going to do infinite banking and all this stuff. To be clear, I want to be transparent. I do own life insurance, and I have borrowed against my life insurance for real estate deals and pay taxes and as emergency. It's got a place, but it's not the entire plan. It's a piece to the plan, right? And so once again, though, you get so locked in on this one thing and you forget about the comprehensive financial planning that can go around. How can these things complement each other, right? Rather than just being all in on this, right? How can we get diversification that helps us get there a little bit more predictable manner here, a little bit more fun of a ride, right? And maybe even get there a little bit quicker. So when we are dealing with somebody and they want to do $500,000, going all the way back, right? Going all the way back, $500,000 into a syndicate. Okay. The problem is if you take that money out of the market, you're going to lose out on the opportunity cost of what that market could be. And if we get 7%, rule of 72, the money in the market is going to double every 10 years. So $500,000 will become $1 million in 10 years, $1 million will become 2 in 20. Okay. Meanwhile, if we don't do it and we don't do the syndicate, we're going to be, missing out on these really good cap rates and really good IRRs, maybe some tax advantages, right? So what we do is we go to the drawing board and say, pause. We can do both here, right? So the magic that I have with all my clients is helping them find the money. And the most powerful thing that you can have in your financial plan is something called a line of credit. Okay. The ability to borrow against your assets so that you can go leverage people like Caleb's intelligence and expertise and hard work here, right? So I'm going to have 3 lines of credit at all times in my portfolio. Number 1 is I'm going to have a home equity line of credit, because guess what? The equity in your primary house is earning you what we call Blutarski. What's a Blutarski? Blutarski is a character from Animal House whose GPA was 0.00, and that's exactly what the equity in your home is getting, right? So why don't we get a line of credit? And number 1, we're going to use that as an emergency fund so we can keep less money in cash, right? Because cash is even though it's been pretty good lately, is inefficient long term, right? So it's an emergency fund, but also now all of a sudden we have the ability to take that and go multiply our investment real estate holdings, right?
Yep.
And that's what I did when we were doing house hacking. I would borrow against my HELOC to go buy another house, right?
Totally.
We use the rental from the last property to pay it off, rent and repeat. Okay, so that's number one. All right.
And I want to pause real quick. Number one,
Yeah.
I want you to get to number two, but that's so powerful because a lot of the higher net worth people that we work with and talk to, they're not like, they think of like even pulling a HELOC for leveraging and different things like that as more of a on the come up tool. But then it's like everything else. It's like, you know, Tim Duncan. I don't know if you were a basketball guy or whatever, but Tim Duncan, San Antonio Spurs, like he was the most boring player to watch ever.
Fundamental.
But he was fundamental. And the thing is like what works on the come up still works when you made it. Why do people stop leveraging the equity in their home to continue to grow wealth once they have a little bit of it?
Caleb, if I can borrow against my home mortgage at 7% and go invest into a hard money lending program that's going to pay me 17%, every $100,000 just created me 10 grand.
Yep.
I don't see what's wrong with this picture, right?
Yeah.
I don't. By the way, I just want to let you know, I'm going to get to number 3 here in a second here.
Yeah.
This is how real wealth is built. But real quick, number 2 is that I do have permanent life insurance and I've got a really good line of credit against it. The one thing I do like about the life insurance line of credit is that I don't have to pay the interest every month, right? So on a HELOC, I've got to pay the interest every month.
Yep.
And life insurance, the interest does capitalize me. It just rolls into the loan there. So it frees up a little bit of cash flow.
Yep.
And frankly, actually right now, that's at 5% interest, 5.3% interest. It's the best interest rate I got, right?
Yeah.
And also I don't have to worry about the value fluctuating as this, typically just goes up. The third thing though, and this is where, getting back to your initial question, do we keep money at Schwab or do we do this? Is that most people don't realize you can go get something called a securities-backed line of credit. You can get a line of credit against your investments, typically up to 65% of whatever the investments are. And in my opinion, it's so much better than a HELOC. And here's why. Number one, it's free. HELOCs can get kind of expensive to get set up. It's free. Number two, it's done in a week. It's all online. It's done in a week. How much of a pain in the butt is getting a HELOC? My gosh, man. It's worth getting, but dear goodness, I have to warn everybody, right? And then number 3, as you invest more money and as those assets grow, your line of credit goes with you, right? So rather than having to get a new appraisal out on the house, these are securities you can just see. So here's what I would say, and Caleb, it would depend on the situation, how much money somebody has. Is, hey, why do either or? What I do personally is I do put all of my excess cash into my investment account because I know it's a little bit more of a well-diversified, safer structure that's probably going to double every 10 years, right? But then I borrow against it to go do hard money lending, multifamily deals, right? Invest in businesses. I'm constantly adding what we call these private placement deals on top of my fundamental core right there.
Yep.
And that's where I really like, that to me is where financial planning gets fun.
Yeah. I love it, man. Like, out of all the financial advisors, I had a few on the show. I think you get it, man. You get this game. Most people in the financial planning, financial advisory space, as we said before, are incentivized to push people in one direction. And another important distinction is something that you said that I thought was really, you never once compared a financial advisor or planner to the steering wheel of the car, because that's the client. Yep. The client determines where they want to go. You're just the one that helps them accelerate and brake at the right times. And if you keep, so for me, for those listeners out there, if you're listening, Alan's your guy, or a guy like Alan's your guy, not your person who just wants to tell you exactly what you should do with your hard-earned money, and they're probably making $103,000 a year. They have no real money of their own.
Yep.
And they want to tell you how you should be doing it, and they want to tell you what you should be investing in and what you should be buying and all that kind of stuff, but not telling you that, hey, you could do both. If you want to invest in this thing, you can actually have your cake and eat it too. It's called a securities-backed line of credit, right? And so,
absolutely.
And what's let me ask you this: what's the downside? I mean, I could imagine, but I want to hear from you. Like, what's the downside? There's always risk when you add in any kind of leverage. So what's the downside of someone pulling a securities backed line of credit against their
You got it, man. Great question. So hey, I want to go back to one analogy you just mentioned. We're not in the driver's seat. We're in the passenger seat. We're helping guide you. Another analogy would be we are your caddy. Okay.
Yeah.
We want to help you choose which club and give you the confidence to swing that club at full force here to get you closest to the hole on this, right? But we can't swing the club for you. It's got to be you, right? And you've got to know the risk of going for that shot, the risk of using that club as well. Another analogy would be owner, coach, QB, right?
Yeah.
Our clients are the owner, right? In general, I'm typically the coach, and we've got another financial advisor we bring in on every case who's the QB. Why is that? The QB's got to be focused in on that play and that play only. I'm the coach. I'm typically looking 2-3 series ahead here. But at the end of the day, I have to tell everybody, like, hey, the QB's not going to go 40 for 40 with 400 yards, right? Our goal is to win the game, right? Sometimes it's going to be beautiful. Sometimes it's going to be ugly, right? But let's talk about risk. We have to make calculated risk in every single deal, in every single scenario. There's risk. Even you keeping money underneath a mattress in cash is risk. Okay. We have two risks. We have the risk, the market risk, deals going sideways, right? We are well aware of that risk. What about the risk of not earning the rate of return that you need to get to where you want to go? That's a significant risk. So in general, putting your money underneath the mattress is a very safe way to lose money.
Yep. 100%.
You will lose money.
Yep.
Right? There's theft, the house could catch on fire, or this tax that we are getting really used to right now, this tax of inflation.
Yep.
Right? And it's going to devalue that dollar, right? So there's safe ways to lose money. Keeping money underneath the mattress is one of them. There's risk in that, even though it seems really safe, makes us feel comfortable. It helps us sleep at night, right? And in general, cash, just in anywhere, is going to be that over time. Right now, cash is actually giving pretty good interest rates, but in general, over time, we will lose money to inflation on there. Yeah. So when we're looking at risk, we need to understand the risk of any of the tax savings that we just mentioned. All those tax things carry some a level of risk to it, right? Cost segregation studies get audited all the freaking time, right? Doesn't mean you don't do it. It's just we need to know the risk, right? So let's talk about the risk of using line of credits. Okay. Number one, we got to be able to pay the interest on these things, right? And when you're using lines of credit as much as I'm using them, all of a sudden those payments get to be a little bit more, right? Yeah. So what I like to do is, particularly with real estate, I like to be on both sides of the balance sheet. One is on the owner balance sheet, where I'm having to pay interest on that, and it's a little bit more of a long-term upside. And then the other one would be the hard money lending here that's paying me income that I can use to help pay off the loans and pay those payments, right? Yep. So being on both sides of being owner and lender gives you a little bit of diversification there, right? Yeah. But when we are borrowing against our lines of credit, and let's talk about your HELOC and your insurance line of credit don't necessarily have this risk as much, but with an investment securities-backed line of credit, you have the risk of things going down, right? You have the risk of investments going down, right? And they call the loan. Now all of a sudden you've got to sell your securities when the market's down, right? Yep. You don't have to sell all of it, right? You may just need to shore up 30 grand of cash, but still we're having to sell securities when we don't want to. Okay?
Right.
All right. So when we get a securities-backed line of credit, number one, I want you to think of it as an emergency fund. It's another way to access money. Hey, you lose your job, your business goes down, and 2008 happens, right? We need to plan for the worst. By the way, we don't worry enough, in my opinion, right? We worry too much, but we never take action. Yeah. Right now, well, we're filming this on September 24th. If you are not seeing some cracks in the economy here and getting a little concerned and increasing some cash positions, I don't think you're taking time to think. Yeah. Right? Yeah. I am prioritizing liquidity right now more than I am in usual time periods. Why? Because we're just seeing seeing labor forces going down. We're seeing permits to build go down, right? Right? Once again, tariffs are going to be a lot more complex than we ever imagined, right? I am prioritizing a little bit more liquidity than usual at this moment in time, right? So number one,
it's very fair.
Getting a securities-backed line of credit, if we do nothing with it, it's an emergency fund, and it's another way for you to get access to liquidity. You can always still sell the stock. If the stock's up, you can always sell it. But if you borrow against it, number one, you wouldn't have to pay capital gains on the sale because you're borrowing against it and that's tax free. Or if the markets are down, you're going to allow them to recuperate. So even if you just get it from a safety perspective, that makes you a lot safer. Now on the risk side, I would highly encourage you, even though you can borrow up to 65, try to keep it around 50 right there. It gives you a little bit more margin there.
Yep.
Because if markets do go down, they can call part of that loan. Now all of a sudden we're having to sell stocks when the market's down. And this happened to one of my clients. And we kind of warned them, hey, we're really close to the sun on this. And then tariffs hit, right?
Yeah.
Tariffs hit, market goes down, right? The creditor made us free, but it was not too much, but like 30K or so of stocks. And then guess what happens? Markets went back up, but he was out of the market by that time, right? Yep. We had to sell and we had to move to cash, right? So we need to understand that there is risk to that. And also in risk, we need to understand that not all these private placement deals work the way that they're supposed to.
100%.
Right?
100%. Couldn't agree more.
It's not anybody's fault. But I'm in a multifamily apartment deal, and we had everything was going well, and then interest rates just went to the moon, and next thing you know, the capital markets changed, and it got pushed back almost going on 3 years now. It's been pushed back, and that money's been locked up. It wasn't anybody's fault in particular. The rules of the game changed. Now we just got good news, and it's going to start building in Q2 of next year, and it's going to be a really good deal again, right?
Yep.
But we need to understand money can get locked up for longer than we want it to. The rate of returns that people, and Caleb, no offense to you, I know you put in a lot of research on what you are saying that the rates of return are going to be, but at the end of the day, it's the best guesstimate that you.
Oh, it is. I tell people, no deal goes to pro forma. It either does better or it does worse. I've never seen a single deal we've put together that hit our projections on the head, because what are projections? They're just a scientific best guess.
That's right.
There's so many factors that we can't predict that are going to happen externally. We can control the internal factors.
Yep.
Right. The internal risk, we cannot, we can prioritize fixed rate debt versus floating rate debt so that we don't have surprises in the future on our debt service, right? Like a lot of deals from 2020 to 2022, and so many floating rate bridge loans that came due, and rate caps are 36 times higher than underwritten, and all these different other problems that now your debt service is higher than your, revenue, and you can't cover expenses. Now your capital call and bringing all the stuff. And we saw it happen. And we've seen so many investors that got burned by that kind of inexperience, flash in the pan of hyper growth from 2020 to 2022.
You got it, right? So let's talk about that risk. And this is why opportunity costs and diversification are so important. We go back to the person that got $1 million. By the way, you can't get a line of credit on qualified money. It's only taxable dollars, right? So if so they could either
makes
sell
total
their stocks,
sense. No Roth IRAs, no traditional IRA. You're not pulling lines of credits against that. Yeah.
You got it, right? So, okay. So if they got $1 million and they would do $500K in a syndicate, they could sell $500,000 right now. They're going to have to pay a decent amount of cap gains taxes. I bet there's some growth in there, right?
Yep.
And then they'll have $500,000. Now they'll have $500,000 working in the market. It'll double over the next 10 years and become $1 million, right?
Yep.
Then they have $500,000 working over here in the syndicate, okay? Well, what if the syndicate goes south? Okay. What if it goes south? And let's be extreme here, because a lot of the risk in there is, all right, the rate of return is not as good. Let's go full extreme. We lose everything, right?
Yeah.
Okay. Well, if you are borrowing against your money rather than selling stocks, and if you sold stocks, you have $500,000 working for you, and it became $1 million. Okay. But if you didn't sell, if you borrowed, you had $1 million still working for you in the market. It became $2 million. And now all of a sudden we can just sell $500,000 of the stocks to pay off the loan, right?
Yep.
And we still have $1.5 million. So that is where diversification makes things safer.
Yep.
So I would argue that you actually leveraging some of your money is safer than you selling and giving your money outright.
All right. It mitigates the downside. I love that strategy. Man, this has been a great conversation. I want to go lightning round through the exit round here as we wrap it up. We ask these questions to every guest, and I personally am going to reach out and we're going to just talk some more and kind of build more of a relationship, because I've got specifically some of my investor clients that I think would really benefit from having conversations with you. But want to go into the exit round. All right. So 5 questions we ask every guest. The first one, we want to be Vogue, man. We want to be, we want to be trendy, and this is the trendy podcast
Yep.
question. So what's your all-time favorite business book?
Hey, I would say the most impactful book I've read, particularly recently, has been Who Not How by Ben Hardy.
Love it.
It really has accelerated my business growth. And it's also something that I think is super important when you're looking at, hey, do I DIY my own financial planning or do I bring somebody in? Right. So I would say that has been the biggest impact book for me recently. I would say going back to when I was growing up, The Science of Getting Rich is one of my favorite books. Wallace D. Wattles is just one of those classics, right?
Yeah.
So those two books I would say really kind of define who I am is The Science of Getting Rich and who I'm becoming is Who Not How.
That's amazing. Love that, Alan. So, obviously we talk a lot about investing as part of owning your exit, right? And so what percentage of your income would you classify as fully passive?
Yeah. It's funny. I think that they lied to us. I think Robert Kiyosaki lied to us when he said that rental income was passive. I don't really see much passive about it, man. So, I'll just tell you my portfolio. We got 6 rental homes, right? I got 6 rental homes. We pull in about 15 grand a month from each of those, right? I'll be honest with you right now. It's really challenging. The silent inflation of property taxes going up, of our insurance going up, of utility bills going up, some of our Airbnbs, frankly, of rents going down, right? I was out of what Robert Kiyosaki would call the rat race. I had more passive income, right, after expenses than I had actual living expenses, right? And guess what? I'm so glad I didn't retire and move to Costa Rica because, man, those businesses they're still they're still making money, but man, it's nowhere near where it was on there, right? So I've got 6 rental homes. I think it's about $15K a month on average. We do, we probably got about $100K in hard money lending that's getting us, I don't know, 17% on there. And then I do, as I mentioned, I got a few things in apartment buildings and businesses. So I do like to leverage. It's one thing to leverage money. It's another thing to leverage people. And that's where really good business owners get in. Yeah. And so if I do a deal with Caleb, I'm leveraging his hard work, his experience, right? His perspectives on there. That is passive. Yeah. That I do. I'm a fan of syndicates. I'm not going to buy any more personal owned real estate because every moment I spend managing that or managing the manager is time taken away from my business that I need to be growing, right? Totally. And when you have kids, it's even more magnified. But going forward, I'm going to be all passive on the syndications going forward.
I love that, man. Love it. What's one thing that you wish that you could do more of, but your business commitments hold you back?
Be present.
Be present.
Be present. As a business owner, the biggest price we pay is not the time and it's not the money reinvested. It's the fact that when we go home after work, it's really hard not to bring the work home with us, right? If I battle every single day to be present on this. So that's the one thing that I wish I had more of is just presence, and I'm working on it.
Yeah. I've heard people say the greatest resource is time and then disagree with that by saying the greatest resource is energy. I would say the greatest resource we have is attention.
Yeah. Oh, right now, I deleted all social media off my phone. All of it. Gone. Twitter, gone. Instagram, gone. Facebook, gone. Like, well, man, that's how I market my business. I'll find a better way to market. It's taking up way too much time.
Or just hire someone to do it so you don't have to personally get on there. Who
that's
not
right,
how,
dude.
right?
Okay,
Who not
that's
how.
what I really did. And honestly, Caleb, this is here's a tip. Here's a tip. If you're checking your own email, it's amateur hour. You gotta outsource it, man. Listen, there's 2 things about email: checking it and then replying. Right, right. Checking it, you can outsource. Replying, particularly on high critical stuff, you need to get in there, right? Yep. But I just recently, because I'm getting 250 emails a day, I recently told my assistant, I'm falling behind. And you know what? It's been one of the best decisions I've ever made as a business owner because email has become such an enemy of our attention.
Yeah, 100%. 100%. Oh, man. So if you could go back in time, what advice would you give yourself about building a business?
Yeah, man, I would say keep scalability in mind. Keep the scalability in mind because over the last couple of years, we grew so fast and added on some amazing clients to the point where I was pulling my hair out, right? And so I wish I would have, going back, bit the bullet, hired a junior advisor to be on all these meetings with me so that they can build a relationship from the beginning, right? And then I can just constantly focus in on bringing in newer clients, because my energy comes in from meeting new people, setting the strategy here, helping them execute on that strategy. And then if we do our plan right, it's automated. Most of it's automated, right? So where we are now, so we have junior advisors going in and do the quarterly reviews for us when things are just kind of just, staying the same. And then if there's a big real estate question or something, that I'm obviously there. But I would say, hey, I should have kept an eye on scalability a bit more.
Yeah. No, that's fantastic. And I tell people that scalability and simplicity are synonymous.
Yep.
Simplicity, because simplicity scales into complexity. But if you start with complexity, it scales into chaos. It's unmanageable. So simplify. I love that. So last question here. What's your strategy for creating, and you've kind of talked a lot about it, but feel free to give one or two additional strategic tips. What's your strategy for creating time freedom and financial freedom for yourself and your family?
Yeah, I think it's important for us to understand, and particularly as business owners, I want you to think of a Venn diagram of personal, business, and your finances all in there. And they overlap right in the middle. And that's where life happens. That's where you happen, right? Yeah. And I want to be clear, all three of those are going to be capped by your ability in each area, right? Mm-hmm. So your business is going to be capped by your personal leadership. Right? So if your leadership is not great, your business isn't going to grow. Your personal finance is going to be capped by your business, and vice versa. If your personal finances are a mess, we're not going to be able to grow the business like we want to, right? And so when we are looking at doing life with our clients, we got to help them grow as leaders. We got to help them grow their business, and we got to help them grow their personal finances right there. So life happens in that interim, and that's where we like to live, because that's where business owners live.
Yeah. No, I love it. Man, I want our listeners to know how they can get more connected with you, get some value from you, but also potentially talk about you giving them some help with their financial plan, man. I mean, I would love to, advocate just based on this conversation. I think, every single one of you listening, it's worth it to at least have a conversation with Alan and his team, because they get it. Most financial advisors are just going to try to sell you products that benefit them. The way that Alan is approaching this is he really wants to help you grow your wealth, secure your situation, be both the gas pedal and the brake, the accelerator and the brake, help you manage risk, help you manage tax mitigation, all of those different things that are essential to not only growing a business, but growing a life and growing wealth, and actually building to the place where you can really own your exit and get to the place where your business, your income, it actually did for you what you set out for it to do for you in the first place, which is set you free, get you to a place of freedom, get you to a place of, as Alan says, critical mass. So, Alan, what's the best way for our audience to get connected with you?
Obviously, I'm on LinkedIn, guys. You can go find me on LinkedIn. But there's two giveaways that I really want to emphasize here. One is more on the personal finances, maybe real estate side. And if you go to my book's website, empowered-money.com, empowered-money.com, there's a free 10-minute financial planning assessment right there. The biggest question I get is, are we on track? Where are we as compared to where we should be? That's a really great start. And it's it takes 10 minutes, man. It's awesome. Obviously, you can listen to all the podcasts that we do as well, and all the podcasts I've been on, like this amazing one. And obviously, you can buy the book there. And that book is 15 years of my best stuff put into one. I didn't hold anything back. I believe that information is cheap. And if you buy that book for $20, you get what people typically pay thousands of dollars to get me, right? But at the end of the day, you're going to still need help executing it. And so, it's a great start to our relationship. On the other side, if you're a business owner, I really want you to go. It's a new website, it's a new company, but we've invested heavily into a software for business valuations. And the biggest question I ask business owners is, what is the value of your business and how did you come up with that number? And they typically don't know, because they see their business as a lifestyle business, as an income stream, and not as an asset that they're going to one day sell to really help their personal plan. Okay. So what I want you to do is go to my new website. It's called thebusinessplanninginstitute.com, spelled exactly as it sounds, thebusinessplanninginstitute.com. Do the valuation. It's going to take you 10 minutes, 20 questions, 10 minutes, and we're going to get you two numbers. Number one, the value of your business, and number two, what the value of your business could be. And we're going to help you bridge that gap between those numbers.
Excellent. Alan, man, this has been a fantastic conversation. I look forward to more conversations with you in the future. And I really appreciate you being here on Own the Exit. That's all we got for today, guys. Thanks so much. We'll see you next time.